Up until a few years ago, I was contributing to both my IRA and 401k as Roth. My thought process was simple. I'd rather just pay the taxes now and not have to worry about it later. I don't regret it, but that mindset was slowing me down on my path to FI. In my highest earning years, I wasn't taking advantage of traditional deductions. Eventually, I had to ask myself, tax-free growth or tax optimization? I made the switch to traditional, and I'm so glad I did it. Others in the FI community might be thinking the same way I was. So I asked financial planner and tax pro Cody Garrett to break down why traditional contributions make so much more sense for most people during their working years. We'll cover 3 reasons why, how to evaluate if traditional fits your situation, and how to let go of the fear of future tax hikes. And if you stick around until the end, I'll share the unexpected benefit of switching to traditional, which helped me hit my FI number faster and gave me the confidence to step into Coast FI sooner. I hope you enjoyed my conversation with the musician turned financial planner, Cody Garrett. Cody, what's going on, man?
I'm so excited for this conversation. I've been talking about taxes to and through early retirement for hours and hours and hours on end and writing this book with Sean Mullaney, CPA. And it's one of those things I don't get tired of it. And I'm really excited too that we're rolling into a new year, going from 2025 to 2026, all the new tax law changes. So all the things we wrote about are now actually happening. Also, Sean reached out to me recently. He said, hey, we need to give people time to actually read and really start understanding the fundamentals of what's in this book. And same thing with you. You reached out to me afterwards saying, hey, I'm in my second read of the book and now I'm ready to have a conversation. So yeah, we're excited that the first conversations were about hey, what's this book coming out? And now we can have conversations about, okay, now I read the book and here are my follow-up questions and how I might apply these to my unique situation.
Yeah, we did almost a Tax 101 episode that was 180, and Sean and Cody were both on the podcast. And then I followed back up with you, Cody, because I'm like, okay, there are some nuanced conversations, almost each chapter could be a podcast episode in itself. And that's what we're doing today. We're really talking chapter 7. One of the big mindset shifts that clicked for me was realizing that in retirement, it's your spending, not your income, that's got to drive your taxes. So can you walk me through how that changes the way that we should be thinking about taxes in retirement?
Sure. So I decided to have a little case study. I'm going to use a single taxpayer in 2026 for maybe even multiple examples today, kind of say, hey, what happens when they're working versus when they're retiring? So I kind of step back with this idea that there's a single filer, and let's call her Grace. Let's even name her. This is fun. We can personalize this, humanize this. So if you're listening to this podcast, your name is Grace. This one's for you. So hopefully you're making a good $100,000. So Grace is making $100,000 as a W-2 employee in 2026. And she is on the path to FI, and she is saving 15% of her income. She said, hey, out of this $100,000 I'm making, I'm going to contribute $15,000 to my 401k. And, before we get too detailed into the traditional Roth, let's just, okay, she contributes that. Also keep in mind that when you're working, your income is called compensation income, which is also subject to what's called FICA tax, which is simply Social Security and Medicare. So the employee and the employer each pay 6.2% for Social Security up to the wage base. And I think in 2026, that wage base is up around about 184,000 or so. Once your income exceeds that wage base, thankfully, you don't have to keep paying that 6.2% towards Social Security. But there's also a small 1.45% that the employee and employer both contribute to Medicare. That's paying for when you do turn 65 and you're eligible for Medicare, that's going to pay for your Medicare Part A, which is covering your hospitalization and retirement. So you're kind of prepaying some of your medical expenses with 1.45% of your income that's uncapped while you're working. So this person is, Grace is making $100,000. 7.65% of that is going toward FICA, which is Social Security, Medicare. So that's $7,650. And let's just start off just simply here saying that she decides just as a starting point, she's contributing to a traditional 401k, making those pre-tax, those tax-deferred contributions. So that $15,000, which is 15% of her income, is going into this tax-deferred account, traditional 401k. So her FICA taxes now are $7,650. So that's unchanged, by the way. You cannot save on FICA by switching from traditional to Roth or vice versa. And then she pays federal income tax of $98.70. So you say, okay, she makes $100,000. Most of us care well, what does Grace actually get paid at the end of the day? She's contributed to that, her retirement account. She's, FICA's been taken away. She ends up with $68,000 a year in net pay. Then you think, okay, well, now Grace gets to live, right? How much income, does Grace, maybe she's done saving. She said, I did my 15%. I got my employer match. I'm going to spend this $68,000. If she's only spending $68,000, like, wouldn't it be nice if she could say, oh, I only want my gross income, my taxable income to be $68,000 too? Like, why can't my spending be a break on my income while I'm working? Wouldn't that be nice if you were only taxed on how much money you spent versus how much money you earned? So that's the employee. But then you think about, okay, well, let's say Grace retires the next year. Good job, Grace. You made it to financial independence, retire early. And she goes, hey, well, my living expenses, I'm in the go-go years now. Like, instead of, I spent $68,000 last year when I was working, but this year I'm going to spend a little bit more travel. I'm going to spend $75,000 in retirement. How much income will Grace have in retirement? Most likely, it's going to be equal to or less than how much she spent. So while working, she's making $100,000 and spending $68,000. So her spending is not a break on her taxable income. But in retirement, her taxable income will be equal to or less than what she's spending.
And the Roth versus traditional debate is really just boils down to, are you going to have more taxable income now, or you got to have more taxable income in the future? Because if all stays the same, if the tax rate stays the same and the amount of income stays the same, it's got to be a net conversation. You're going to end up paying the same amount. But we're really making the case in this conversation that it isn't going to be a net. It isn't all equal. And that's not to say that we think tax rates are dropping, but we know that your taxable income in the future is probably dropping. To illustrate what Cody's saying here, Grace made $100,000 and she's got to get taxed on that $100,000 in her working years. That's how much she made, although she's only spending $68,000 because you have to take out the $15,000 that she was saving plus paying for taxes. And you'll pay for some taxes, but not all the taxes. And we'll get to FICA here in a little bit. Versus in retirement, she only needs $68,000. Shoot, she can even add another $7,000 because she wants to do a big cruise or something. And she's only going to have a taxable income up to the amount that she's spending, maybe even less because of some other things that we're going to talk about here in the near future too. So all things equal, she's for sure got to be paying less taxes in the future because she's not going to be saving and investing, and she's not going to be paying as much in taxes, especially that income tax, that FICA tax. Another thing that we talked about is that we've been kind of circling around is a bunch of these favorable income characteristics of retirement income. So let's kind of go back to the Grace situation here. She's taking out $75,000 from her portfolio, but it is almost a guarantee that her taxable income is not $75,000. Why is that?
Yeah, so our order of operations, a lot of people, they get to retirement and they assume, oh, I'm going to start taking money out of retirement accounts. But that's actually not the first part of the order of operations in distribution and drawdown. It's actually starting with taxable accounts first. So let's say, Grace gets to retirement and she probably has some money in her checking account, her savings account. Maybe she has a taxable brokerage account. So maybe even beyond the 401k, maybe she's been investing in ETFs, mutual funds, individual stocks, choose your own adventure on investments. But she probably has some checking, savings, and taxable brokerage accounts in retirement. Those are actually the first accounts we pull from in retirement. And by the way, this is for early retirement and in traditional retirement. You want to spend down your taxable assets first. And the reason why is that, have you noticed that when you go to the bank account and take out, let's say, $20,000 to buy a car, you don't receive a tax form in the mail the next year saying you're taxed on that $20,000. So in taxable accounts, your checking, savings, taxable brokerage, the amount you put in, when you withdraw money from that account and spend it, you aren't taxed on the amount that you take out. You're only taxed on the amount that you realize as capital gain. So a quick example is that Grace, let's say that while she was working, she contributed $75,000 to a total stock market index fund. The first year of retirement, she goes into that taxable brokerage account, and now it went from $75,000 to $100,000. If she sells all that $100,000 to live that big juicy life in early retirement, how much is she taxed on? Not how much she sold. She's only taxed on that realized capital gain, the difference between what she bought it for, $75,000, and what she sold it for, $100,000. She is only quote unquote taxed. She only has gross income in that case of $25,000. So that's part one, that's called basis recovery, that whenever you sell a capital asset like a mutual fund, ETF, stock, and a taxable brokerage account, you're only taxed on the capital gain that you realize. Not only that, there's actually two different calculations for income taxes. There is your ordinary taxable income, which is like your W-2 income, maybe your distributions from retirement accounts like traditional IRAs, things like self-employment net income. But then on the other side, there's this thing called capital gains taxable income. And those are different tax brackets and tax rates that are specifically for qualified dividends, which is mostly the dividends you're getting from like your US, your domestic stock, your mutual funds, ETFs, and also from those capital gains, specifically if you sell an asset that you've held for over a year. That's called a long-term capital gain, right? So let's say, for Sarah's 75,000 to turn into 100,000, that probably happened over, a few years or so. I know the stock market's been really great to us in the last few years, but what's cool, if she held that stock or that ETF, let's say, for more than 1 year and sold it, that 25,000 of capital gain is included on her tax return. But this is amazing. First off, as a single taxpayer in 2026, her first 16,100 of income period is completely wiped out by the standard deduction, regardless of what type of income. So that 25,000 that we just talked about, right? So 25,000 as her only income source minus 16,100. Now she only has taxable income of $8,900. And you might go, oh, well, she's going to be taxed on that, right? But no, because that is long-term capital gains income, there's a massive 0% bracket for long-term capital gains and qualified dividends. So Grace is spending $100,000 in retirement and pays zero taxes in federal income tax.
That is absolutely crazy.
I would say if she just did that, she's not even taking full advantage, right? Yeah. She has still up to the top of the 0% bracket for long-term capital gains. This is called tax gain harvesting, by the way. And she might also say, hey, I didn't contribute to Roth while I was working, but now that I'm retired, it's not Roth now or never. It's Roth now, later or never. Now she's in the later stage. She's going to say, hey, I deferred those traditional 401k contributions at 22%. And now I'm going to convert a little bit of that in the 10% and 12% bracket, which is less than half of what she was saving when she was contributing. So we talked about the ordinary income tax, right? So I'm just going to quickly say that in 2026, the separate tax brackets for long-term capital gains, right, and those qualified dividends for single filers after the standard deduction, taxable income up to $49,450 is taxed at 0%, right? Wow. We had that example of her having a little bit of a capital gain tax at zero. So that could be up to $49,450 after the standard deduction, tax at 0%. And married filing jointly, it's double that at $98,900.
Let me get this right. So the $16,000's got to be the standard deduction. You're going to get the reduction, and then you're going to get another $49,000 almost on top of that. That's got to come out 0%, assuming it's long-term capital gains.
Right. So a single taxpayer who just lives off of long-term capital gains from a taxable brokerage account could actually have total capital gains of $65,550, all taxed at 0%. So part of it's wiped out by the standard, and the rest is the 0%. And married filing jointly, if you want to get exciting here, marrying filing jointly in 2026, that number is total capital gains of $131,100. If that's their only income source, they pay zero in federal income taxes.
That is bananas. That is bananas. And once again, that is probably being deferred from the 22% tax bracket in their working years. So there's not an apples to apples here. Like it truly is a huge advantage to take the deduction when you are paying the most taxes and then pay the taxes when you're paying the least amount of taxes. She's got to be taking out probably less income because she's got to be not taxed at how much money she's making, but actually just how much she is spending. She's got to get advantage, some favorable treatment on long-term capital gains versus W-2 ordinary income, and basis recovery in all of this. And then on top of that, FICA taxes. She's not going to be paying, Grace in this example is not going to be paying FICA taxes, which on $100,000 is actually a significant line item in her situation. Is that right?
If you think about while she was working, 7.65% goes to FICA. So, $7,650, you might not sound like a lot of money to you, but that is almost $640 a month that she is not paying in FICA when she's retired.
Yeah. And then once again, she doesn't have to account for that in her spending plan, taking the $7,600 off of her spending, which would be 22% of that. It's a significant amount of savings. And if you're self-employed, it's even more. You're talking like 15% almost on some of this if you made most of your wealth through self-employment.
Yeah, that's actually a big case. If you want to include in the show notes, I actually have a video that shows step-by-step how married filing jointly couple is taxed in retirement and also as a single self-employed person is taxed. And what's fascinating about that is when you're self-employed, because you're both the employee and the employer, you're on average paying about 14 to 15% of your net profit is going to self-employment. Yes, you're able to deduct half, but keep in mind that a deduction is not the same thing as a credit. It's not like you get that money back. So most people who are self-employed, they're going to pay way more in self-employment taxes than they will in ordinary income tax.
So I think we made the case that you're going to have significantly less taxable income in retirement versus your working years. But the big thing that always hung me up on this whole Roth versus traditional is the fact that I think taxes are going to go up in the future. We're running a deficit in this country, and I just don't see a situation where I'm not paying more in taxes in the future whenever I'm retired. So why not just take advantage of tax rate arbitrage right now? Is there any counter argument that you have to that?
Absolutely, we do have a counter argument to that. So my co-author of the book, Sean Mullaney, he created this awesome chart called the Litany of Recent Tax Cuts for Retirees. And I know that right now there's kind of this idea that there's no way tax rates can go down. There's no way that we can't do something about this federal debt. On this chart, this is really interesting. It's from 2015 to 2025. There is a lot of talk that if I talk to a Republican about taxes, they're like, just wait. As soon as the other party gets in, we're going to be crushed with taxes. I talk to a Democrat and they're like, just wait. Even now, like, just wait. As soon as the person on the other party comes into the White House, they're going to crush me in taxes. And from 2015 to 2025, we had changes in presidents. We had changes in Congress. But what's funny is 2015, the federal debt was 17.82 trillion. There are a lot of things that happened between now and then, but back then it was 17.82 trillion. The federal debt, September 2025, $35 trillion. They're like, okay, well, it can't get worse than, but you look at what happened in between then. Like when you're at 20 trillion versus almost 40 trillion in federal debt, like somehow we think they're going to do something about that now, part one. Part two, we suddenly think they're going to, reduce that debt specifically by taxing retirees more, which is exactly the opposite of what they've done over the past 10 years. So a few things they did in the last 10 years to specifically benefit retirees: the Tax Cuts Jobs Act in 2017, that reduced that nearly doubled the standard deduction, which we just talked about, that lowered the tax brackets, both for the ordinary and long-term capital gains. Then in 2019, the Secure Act, that delayed required minimum distributions, right? When you're retired, your traditional 401k, traditional IRA, we view that as an asset on the balance sheet, but the IRS sees it as income that hasn't been taxed yet. There's a lot of fear around that, but I would say on average, Americans will pay less tax in retirement than they did while working. So the Secure Act delayed those RMDs, changing them from starting at age 70 and a half to 72. Then the CARES Act came along in 2020. They suspended the RMDs for that year because of COVID. Even if you already took your RMD, you could roll it back into your retirement account. Also in 2020, they increased the RMD factors, meaning if you did have a required minimum distribution, you didn't have to take out as much. Then in 2022, we had Secure 2.0, which delayed the RMDs again. So we went from 70 and a half to 20 to 72 to 73. And now if you were born in 1960 or later, your RMD won't even start till you're 75. So if you do have required minimum distributions in retirement, like how many years do you really think you're going to have these things, like knocking at your door? And then lastly, in 2025, the One Big Beautiful Bill, whether you think it's a big beautiful bill or big ugly bill, it made those Tax Cuts Jobs Act's tax cuts permanent. It also created a senior deduction up to $6,000 per taxpayer, 65 or older. Also, it provided some benefits for those who retire before 65 on ways to continue contributing to an HSA covered by a bronze plan with the health insurance marketplace. So again, presidents changed from Democrat to Republican to Democrat to Republican. The federal debt just kept going up, but taxes specifically for retirees became even more favorable. So why do we believe now in 2025 that future politicians are going to suddenly start taking the federal debt seriously? Not only that, but they're going to say, the way we're going to reduce this debt is by going against our own best interest, by taxing the people who vote the most, which are people in their 50s and older, who are, one, worried about running out of money in retirement, and two, are feeling tax payments most viscerally because they're the ones actually making quarterly estimated tax payments or having to go in to elect how much of their retirement distributions are withheld for taxes. So I'll just say that there's a history of, even if taxes go up, like, will they go up for retirees? That's probably the last cohort that politicians would want to tax moving forward.
Yeah, I think that makes total sense. And in your book, you said the wrong question is, will taxes go up in the future? But the right question is, will taxes go up in the future for retirees? And the whole argument that you just laid out there makes total sense. And I don't think we need to get into it in this conversation, but we were talking before we even pressed record that even if the tax rates go up for retirees, they almost have to double for the math to really start making sense, to think through this and really start contributing from a Roth standpoint versus a traditional standpoint.
That's right. So I've worked with, a few hundred early retirees, people from their retiring at 40, retiring, being in retirement at 80, et cetera. And I would say it is very rare for me to work with any financial planning client, by the way, on average having $2.5 to $5 million in investable assets with an average federal income tax rate above 10%. And most of these, a lot of them love Roth. They love Roth, but they were really glad that they're taking money out of their accounts taxed at, an average of 10%. Whereas when they were working, a lot of the people who are retired now didn't have these new tax rates of 22, right? 22%, 24. They were at like the 25, 28, sometimes even like the 39% plus tax rates. It's very rare for the average American or even the affluent, the well-off, wealthy American to have taxes as an average be higher than their marginal highest tax rate while they were working. So again, the math, I would say, if you might be saying, hey, well, Cody is all traditional all the way every day. I just say no, it's just, there's a basic concept of pay tax. Choose to pay tax when you expect to pay the least amount of tax. And if you want to kind of go one step further, right, pay tax when you have less taxable income. When do you expect to have more taxable income? When you're working for an income or when you're retired and not working for an income, right? That kind of just simply solves the idea that if you aren't receiving some massive public or private pension, you're retiring at 70 right when Social Security is claimed at the latest date, right? Most people listening to this, I would say that there's a little stat in the book, by the way, that we found that over 70% of Americans report retiring before age 65. So not only are they retiring early, but what does that mean? That gives them a huge opportunity, sometimes even a decade before RMDs start, to say, hey, I didn't contribute to Roth while I was working. I was deferring at 22+%. But now in retirement, I have an opportunity to Roth now to say, hey, I'm going to now convert that money to Roth. I'm finally going to get the Roth I wanted, but I'm going to pay 0%, 10%, and 12% to get into Roth now. It's not Roth now or never. It's Roth now, later or never. And for most people on the path to retirement, the later is going to be when they want to when they want to get into the Roth accounts. And just quickly here, last thing on that is we're big proponents and we prefer that most Americans would be benefiting from contributing to traditional retirement accounts at work. So traditional 401k, 403b, 457b, the TSP if you're a federal employee, but then going to Roth in the IRA, because most high earners, they're not foregoing a tax deduction to contribute to a Roth IRA, maybe with the back door. And then lastly, if you have extra savings, maybe using the mega backdoor if your workplace plan allows that. And then lastly, just saving into those normal taxable brokerage accounts, which are super flexible, not just in retirement, but on the path to retirement.
Yeah, like I said in the introduction here, we're optimizing for flexibility. We're not, and especially in the FI community, where I don't even think we're going to have a decade. We're probably going to have closer to 2 decades to really optimize taxes. And whenever you come in with these larger traditional accounts, you just have many, many of years to do some of these Roth conversions. And you even illustrated in the example today where I'm going to pay 0% on long-term capital gains up to, the standard deduction plus another 49 or something. There are going to be moments, especially with how frugal this community is, to make some massive Roth conversions and really move that traditional into Roth and really not have to worry about RMDs and some of the other situations that might impact you down the road.
Yeah, and I'll just add there that there's a lot of excitement when you do get to the later stage. You're like, now I can do Roth conversions. Just be very careful not to overdo it. We're seeing a lot of people get too excited and then they convert too much to Roth, right? And then they end up paying more tax than necessary. So if somebody's excited, they're like, I'm going to convert $500,000 to Roth. I encourage you, don't get too excited about the Roth, and I always say don't rush into Roth here. So if they converted all of that $500,000 to Roth in 1 year, they'd be paying an effective average tax rate of 28%, which might be like, well, 28%, maybe they were deducting that when they were working at 32. That's a win, right? 28%. But what happens if that person, instead of converting $500,000 all in 1 year, they spread that out and maybe from age 65 to 69, they spread that out over 5 years, $100,000 per year instead. So if they decide to convert $100,000 a year for 5 years, instead of converting $500,000 all in 1 year, they'd pay a 13% effective tax rate instead of the 28%. Just be careful there. Like, don't overdo it. Not only might you have multiple years, even decades to convert to Roth, but you also, at some point, you might want to be strategic with not overdoing it, because sometimes, as we mentioned, like, don't lose out on the standard deduction in the future. Yeah. Also, another great example of ways to use traditional retirement accounts is once you turn age 70 and a half, if you're already giving to charity, you can give money directly to charity from your traditional IRA as a qualified charitable distribution. And that means while you were working, let's say you were deferring at 22%, then in retirement, you give that to charity. The charity doesn't pay tax. Like, you just got a nice free gift from the government, and the charity is very happy to get their money.
That's awesome, Cody. Well, I think you laid out a really good argument for why almost everybody in their working years, especially the FI community, should almost be defaulting to traditional over Roth. There might be some very, very niche cases where Roth might make more sense, which we can maybe get into in a future episode. But Cody, I had a blast. I loved reading your book. Like I said, I'm second time through this. You and Sean were so good at creating a resource that this community really needed. So that's Tax Planning to and Through Early Retirement. Where can people find that book, and what can they expect if they pick it up and read it?
Yeah, you can get it on Amazon with Prime shipping. Go for it.
And I like it. You do a good job of breaking out the chapters and having a good table of contents. So even if you don't want to pick up and read a 250, 300-page book about taxes right now, but you need some help or support in certain specific areas, I think you guys have like 20 or 30 chapters, and you're very good at titling each of those chapters. So if you just want to flip and, open up one specific chapter on a current tax situation that you're facing, it's a really good resource book too. So highly encourage people to go and check it out.
I appreciate it. Yeah, the book has 38 chapters. They're, like one step at a time. It's also more of a resource than a book you just read. Like, it's something you come back to in future years. And also, there are over 120 step-by-step calculation examples. So rather than just saying our opinion on whether we think, traditional is better because I like traditional, or Roth is better because I like Roth, we used over 120 step-by-step examples to show the math, show some more objective, have more, rational, objective behavior in retirement on the path to and through early retirement.
Well, once again, folks, this is Cody Garrett, Measure Twice Money, and the author of Tax Planning to and Through Early Retirement. Cody, always a blast chatting with you. Hopefully this is one of many conversations in the future.
Oh, I'd love it. Let's set up a weekly.